Iron Financial. This is the only channel dedicated to forging a stronger portfolio by cutting right through the market weakness. I'm your lead analyst, and with me, as always, is our market skeptic. Today, we are putting on our hard hats. We are digging into the Q4 earnings report from a titan of American media and technology, Comcast. Look, this is a company at a major crossroads, a behemoth trying to reinvent itself in real time. So the question we're here to answer is actually pretty simple. Is this a solid investment, or is the whole structure about to come crashing down? Let's get to work.
Okay, let's just jump right in. Right off the bat, the headlines from Comcast's Q4 report are a classic Wall Street paradox. On one hand, you see a solid beat on earnings per share. They reported 84 cents per share, which absolutely smashed the Zacks consensus estimate of 75 cents. That's an 11.66% upside surprise. And when a company beats expectations by that kind of margin, the bulls usually start running. But then you look at the other side of the ledger. Net income attributable to Comcast plummeted a staggering 54.6% year over year. So what gives? An EPS beat is nice, sure, but when your actual profit gets sliced in half, that's a massive red flag. It feels like the underlying business is really struggling to generate real profit, even if they're finding ways to make the per-share numbers look pretty for Wall Street. I'm just not buying the hype yet. What's the real story behind these numbers?
That is the exact question we are here to deconstruct. This isn't just about one quarter's numbers. This is about the fundamental story of the entire company. We are literally looking at a tale of two Comcasts. First, you've got the legacy business, the pipes, the cable, the broadband. That's the foundation of this whole empire. Then you've got the new Comcast, the skyscraper they're trying to build on top of it, with theme parks, streaming, and content. So our job today is to act as structural engineers for your portfolio. We're going to inspect that legacy foundation for any and all cracks. We're going to assess the structural integrity of the new skyscraper. We're going to follow the blueprint, and by that I mean the cash flow, to see how it all holds together. And finally, we will deliver Iron Financial's verdict. Is Comcast a fortress built to last, or is it a skyscraper built on sand?
All right, so let's start where you have to start, at the bottom, with the foundation. This is Comcast's bread and butter, their connectivity and platform segment. We're talking about Xfinity Internet and Xfinity TV. For decades, this thing was a machine that just printed cash. But the ground is shifting under their feet. We need to check for cracks.
And you know what? We don't have to look very far to find them. Just look at this number, a net loss of 181,000 domestic broadband customers in a single quarter. This is not a small leak. This is a major stress fracture in the foundation. For years and years, broadband was the unstoppable growth engine, picking up all the slack from cord cutting. Well, now that engine is sputtering. The competitive environment, and their own CFO admitted this, is intense. They are getting squeezed from every direction by fiber optic alternatives and the crazy rise of fixed wireless from the big telecom players. This isn't just a blip. It is a trend, and it's deeply, deeply concerning. And remember, this isn't just about losing customers. It's about losing the very platform that they've built their entire wireless business and their customer relationships on. If this erosion keeps up, it could have a dangerous ripple effect across the entire company. This is the bedrock, and it feels like it's crumbling right before our eyes.
Exactly. And if broadband has a crack, the legacy video business is a gaping sinkhole, a loss of another 245,000 domestic video customers in Q4. This isn't exactly news, of course. We've all seen the cord-cutting trend for years. But the point is, the bleeding isn't slowing down. They ended the year with just over 11 million video subscribers. Just think about that for a second. This used to be their flagship product, the absolute crown jewel. Now, it's just a rapidly melting iceberg. This part of the foundation isn't just cracked, it's completely falling apart. It's a constant drag on their customer relationships and a symbol of their past, not their future.
Whoa, hold on, let's not call the demolition crew just yet. Yes, the residential side, which includes that declining broadband and video base, is weak. Revenue down 2.1%. I see it. But that is not the whole story of the foundation. Now, what's really interesting about this slide is how it shows a strategic pivot in action. Look at the other pillars of their connectivity business. Business services revenue is up a very healthy 5.8%. And then there's the real standout. Domestic wireless revenue is up an explosive 18.0%. This isn't just them doing a minor repair job. They are actively reinforcing the foundation with new, stronger materials. They're moving into higher margin enterprise services with business clients, and they're building a massive new revenue stream with wireless. This is a strategic shift that could more than make up for the declines in their legacy residential business over the long term.
And this number right here illustrates the point perfectly.
9.3 million wireless lines. This is a business they built completely from scratch on the back of their broadband network, and it has been a runaway success. They added 364,000 lines this quarter alone and 1.5 million for the full year. Management literally called 2025 their best year ever in wireless. This is a key part of what they call their converged connectivity strategy. They're bundling mobile with internet, creating stickier customer relationships. Just think about it. If you get your high-speed internet and your phone from the very same company and you're getting a great deal on the bundle, you are much, much less likely to go through the hassle of switching providers. That creates a powerful competitive advantage and locks customers into their ecosystem. So while the skeptic here sees crumbling concrete, I see a company intelligently re-engineering its foundation to support future growth. It's a critical and often overlooked part of the bull case.
All right, so the foundation has some pretty serious cracks, but it's also got some powerful new reinforcement. Let's move up the structure and look at the skyscraper they're building on top of it, the content and experiences segment. This is where the big bets on the future are being made: theme parks, media, and the all-important streaming service, Peacock. And this part of the structure, let me tell you, is built with solid steel. Theme park revenues soared almost 22% in the fourth quarter. This is a phenomenal result. The driver, the hugely successful opening of their new park, Epic Universe. People are flocking to their destinations, and they are spending more money than ever before. In a world that is increasingly focused on digital experiences, Comcast is proving that high-quality, real-world entertainment is an incredibly powerful and lucrative business. This is not just a nice side business. It's a core growth engine and a massive steel girder in their new corporate structure.
And it's not just about revenue. It is about pure profit. For the first time ever, the theme parks division generated over $1 billion in adjusted EBITDA in a single quarter. Let that sink in for a minute. For those who aren't familiar, adjusted EBITDA is a measure of a company's operating profitability. It's basically the cash they're generating from their core operations before things like interest and taxes get factored in. It gives you a really clean look at the health of the business itself. And in this case, $1 billion in 3 months shows that this segment is an absolute cash machine. It's a high-margin, high-growth engine that provides a tremendous amount of financial ballast to the entire company. It's the kind of reliable performance that investors should be drooling over.
Okay, let's move to another key component of the skyscraper, Peacock. Now, for a long time, Peacock was seen as a laggard in the streaming wars. No question about it. But the narrative is really starting to shift. They now have 44 million paid subscribers, which is up 22% from a year ago. They added 3 million in this quarter alone. That's real momentum. They're leveraging their unique assets, particularly live sports like the NFL and now the NBA, to drive those signups. The strategy really appears to be gaining traction, and they are carving out a meaningful space in a very, very crowded market.
Momentum or a money bonfire? You cannot just show me a subscriber number without showing me what it costs to get there. Peacock lost a staggering $552 million in Q4. That's a huge step backward from the $372 million they lost in the same quarter last year. So let me get this straight. The more subscribers they get, the more money they lose. That's not a business model, that's a charity. They're essentially paying people to use their service. This so-called momentum is being fueled by incredibly expensive sports rights, like their new NBA deal, which is driving up programming costs. And with the cost of content and sports rights only going up, this problem is probably going to get worse, not better. How long can they sustain burning over $500 million every 3 months? This looks less like a key feature of the skyscraper and more like a ticking time bomb in the basement.
And this table right here proves my point. The entire content and experiences segment would be in serious, serious trouble without the theme parks. Just take a moment and look at the data here. Theme parks, as you said, delivered over $1 billion in adjusted EBITDA. Fantastic. But at the same time, the media segment, which includes that cash-burning Peacock, swung from a nearly $300 million profit last year to a $122 million loss this year. That is a massive negative swing. And the studio segment is also showing weakness, with profits down nearly 40% year over year because of a weaker film slate. So the crucial point here is this: the theme parks are doing all the heavy lifting. The skyscraper isn't a balanced structure. It's a lopsided tower being held up by a single, albeit very strong, pillar. And that's a risky design for any builder. That's a fair point. The internal structure of the skyscraper definitely has some imbalances. But to truly understand the integrity of the entire project, we need to look at the master blueprint. We need to follow the cash. So let's zoom out and look at the consolidated financials to see how all these moving parts, the foundation and the skyscraper, actually come together. And this, right here, is the number that underpins the entire bull thesis for Comcast: $19.2 billion in free cash flow for the full year. Now, free cash flow is the ultimate measure of a company's financial strength. It's the cash a company generates after you account for the capital expenditures necessary to maintain or expand its asset base. It's the money they have left over to do whatever they want with, pay dividends, buy back stock, or invest in new projects like Peacock. And in Comcast's case, it's a massive, massive number. This is the raw financial power that allows them to absorb losses in a division like Peacock, invest billions in their theme parks and networks, and still have mountains of cash left over. This isn't just a number, it's a financial fortress. So where does all that cash go? This chart breaks down their capital allocation for 2025. They spend $11.7 billion on capital expenditures. That's reinvesting in the business, upgrading their networks, building out new attractions. Then they returned a massive amount of capital to shareholders, $4.9 billion in dividends and another $6.8 billion in share repurchases. From my perspective, this looks like a disciplined and balanced approach. They're investing for the future while simultaneously providing a direct return to owners of the stock. But I have a feeling you see it differently.
Oh, I do. I see a company spending nearly $7 billion on share buybacks. Now, is that a sign of confidence, or is it a way to prop up the earnings per share metric while the underlying business faces serious headwinds? Let me explain. By reducing the number of shares outstanding, buybacks can make the earnings per share look better, even if the company's total profit is flat or even declining. It's a trick to make the numbers look good for Wall Street without actually fixing the core problems. When your main customer base is shrinking, spending that much on buybacks instead of more aggressive investment or debt reduction, it just feels like financial engineering. It's a short-term fix that could be masking long-term problems.
All right, we've inspected the foundation, we've toured the skyscraper, and we have reviewed the financial blueprint. We've heard the bull case, we've heard the bear case. It is time for the final analysis. It is time for Iron Financial's verdict. Is this media giant built to last, or is it doomed to fall? From my perspective, the bull case is built on a foundation of undeniable financial strength. That $19.2 billion in free cash flow is an absolute force of nature. It provides a massive margin of safety. They have a proven, high-margin growth engine in their theme parks, which are firing on all cylinders and just pringing cash. Their wireless strategy is a masterclass in leveraging existing assets to create a new, fast-growing business that is successfully offsetting weakness elsewhere and building a moat around their customer base. And finally, their disciplined approach to capital returns, paying a solid dividend and consistently buying back shares, directly benefits us, the shareholders. They are navigating a difficult transition, no doubt, but they have the assets, the strategy, and the financial firepower to succeed. The bear case, however, argues that you can't just ignore the cracks in the foundation forever. Their core connectivity business, the very source of that fortress-like cash flow, is eroding. Customer losses in broadband and video are real, they are accelerating, and it's all due to intense competition that is not going away. At the same time, their biggest bet on the future, Peacock, is a financial black hole, burning cash at an unsustainable rate with no clear path to profitability in sight. You add to that a studio business that is volatile and currently underperforming, and you have a very, very dangerous combination. A legacy business in decline and a primary new growth initiative that's losing billions of dollars. That's a recipe for disaster. So, at the end of the day, the ultimate question for any investor looking at Comcast is this. A new skyscraper is being built, but it rests on an old and in some places cracking foundation. That massive cash flow is the cement mixer constantly pouring resources into reinforcing the old and building the new. But can they finish the skyscraper? Can they get Peacock to profitability and continue growing their new ventures before the erosion in their core business causes the entire structure to become unstable? That is the billion-dollar question you need to answer for your own portfolio. Thanks for joining us on Iron Financial, where we forge stronger portfolios by putting companies to the test. We'll see you next time.